Supercore proves to be super hot, making the markets super sad.
Oh, I love that.
Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I love symmetry like that. And I'm Alex Steele. We're kicking you off to the closing bell right here in the U.S. And yeah, the markets are super sad. In fact, around the lows of the session, the S&P is off by almost a full 2 percentage point, really shaking out. The NASDAQ 100 also off by 2%. We also knew that Citi was saying that the long positions are already so extended on the NASDAQ that it didn't really take much to tip over into some selling. The dollar, though, beneficiary here, up by 0.7%. In fact, it's the highest that we've seen since November, caused dollar yen to skyrocket through 150. That's usually the level that we talk about BOJ intervention. And the 2-year yield is where you saw a lot of the action. It was all across the curve, but the selling really pronounced in the front end, up by 17 basis points, rising the most since last March. Romaine.
Yeah, a dramatic day here in markets. And of course, that's all on the back of that big CPI report that we got this morning. The market really taken down by that report, and really the hopes now dash for a continued drop in inflation. Dash hopes for the start of a drop in Fed interest rates as well, with that so-called core consumer price index, which excludes food and energy costs, increasing at a faster than expected 0.4% pace from December. That's the most in about 8 months. You back out shelter and energy costs, and that so-called super core services prices that everyone has been keeping an eye on, that climbed 0.8%, the most since April of 2022. Now, it is the economically and, well, for that matter, rate-sensitive stocks really faring the worst today. The Russell 2000 right now down about 4%, sliding the most since at least September, mid-2022, I should say, dragged down by real estate, materials, and consumer discretionary names. You have SL Green, big commercial property investor here in New York, having its worst day since October. Higher for longer interest rates, at least for now, look like they remain a threat. Lithium miner Piedmont having its worst day since at least last February amid continued softness in EV sales. An online education company, 2U, hitting a record low after flagging substantial doubt about its ability to continue as a going concern. Remember, a path to multiple rate cuts was supposed to be the salvation for a lot of these small and mid-cap names. But with dodgy balance sheets and debt refinancing needs on the horizon, today's CPI reports is creating a lot of turbulence out there for that glide path for 2024. And now, Alex, believe it or not, raising the not-so-bizarro possibility of rate hikes in 2024?
I was laughed last week when I talked about a reacceleration.
I did. I think I was the one who laughed at you.
You were, and now maybe we're talking about it. And just yesterday, it was you want to sell tech and buy small caps. What a difference a day makes. So this is what we're expecting for December 2024 in terms of rate cuts. So it's basically looking at rate cuts for the whole year. Now, come last Friday or Monday, we were kind of bopping along, just a little under 5 cuts. And all of a sudden, you get the CPI today. Look at this spike. Now, we're only looking at about 3.5 cuts now priced in for 2024. Just an enormous re-rating all across the board from 7, then to 5, and then now to 3.5. Maybe, Romaine, the Fed was kind of right all along.
Yeah, that seems to be the narrative that's been unfolding. Whether the markets can actually, stomach it is a whole nother question. Diane Swong joining us right now, chief economist at KPMG, to help us kick off to the close. And let's get right to it. Diane, were you surprised by this report this morning?
Well, I was surprised, especially in how much inflation there was in the super core, that service sector inflation. Now, not all of that will translate into the PCE, which is what the Fed's target is, but it really was important to see where the increases were. We saw increases in everything from hotel room rates to things like insurance costs, vehicle insurance up at its fastest pace since 1976. That's really stunning. We all know some of that is due to a surge in extraordinary weather events that have caused more damages to vehicles, but this is something that's also undermining the affordability of vehicles at the same time. We're also seeing increases in medical costs, and it's not just insurance. Part of that is more of a wage story, and one that the Fed is going to be watching extremely closely, because that side of the equation had been one area where we were worried there could be more inflation, and now it could be showing up. The good news is we're continuing to see goods inflation fall. Mm-hmm. So we're seeing deflation in the goods sector, but you need a lot of goods sector deflation to offset that super service sector inflation that we're seeing out there.
I am curious, and forgive me if this is a dumb question, but for some of those sectors in this report where we did see that significant uptick in inflation, why did we not necessarily see that, I guess, in the reports in the couple of prior months here? Was there a sort of a gradual run up to this, or did this just kind of come up out of the blue?
Well, certainly the vehicle sector, in terms of vehicle insurance, that's been going up really rapidly all year. And so we saw a big increase last month in that as well. So that's not new. Also, medical insurance is being measured differently. That's been going on since the fall, and that's been compounding, and that's showing up because more medical insurance costs are being picked up in that index. But I think we are starting to see some of the healthcare. Remember, that's been one of the driving sectors for employment. That's a structural shift in demand. However, it also is putting pressure on the labor market. And I think that's a place where you have to worry about where wages may not have cooled enough to derail a service sector inflation. And what the Fed is worried about is that improvements in inflation will stall out. This sort of validates their view to keep monetary policy restrictive, even though inflation has come down very rapidly. It doesn't mean we necessarily have to do a rate hike. I think the first rate cut is in June, but we only have 3 rate cuts this year. And that really is sort of consistent with what Jay Powell had said at the press conference in January, and that was the dialing back of restrictive policy. This is not rate cuts to stimulate the economy. And the fear is that if they cut too quickly, they could really reignite the cooling embers of inflation.
So you wouldn't label this as a reacceleration of inflation, just like a pause in the disinflation?
I think it's just a bump in the road, but I think this is part of what we are due for. One of the things the Federal Reserve was worried about was that many of the things that got us to the rapid slowdown in inflation that we saw last year, the rapid cooling, were one-offs, the healing of supply chains, things like that. And they were worried that even though service sector inflation looked like it might be coming down, that's where it could get stickier and have it stall out. This just suggests not necessarily that we're reaccelerating per se. We need to see several months of that, but that the road to getting to 2% is in fact bumpy. It's not linear. And the Fed is right to be cautious in how rapidly they cut rates.
So you were saying the start in June. Do you agree then with where the market is right now? You're looking at about 3.5 cuts?
Well, that's where we've been. And so we're in June and we stay in June and we have 3 cuts for the year. And that's where the Fed is. And I think when we see the summary of economic projections in March, we will see them stay at 3 rate cuts for the year, but you'll see more clustering around 3 rate cuts. There'll be more consensus within the Fed for 3 rate cuts in 2024. They want to sort of straddle this. They don't want to destroy the economy. They like the strength. They just don't want to rekindle any inflation or have it stall out too close, too much above 2%. They'd like it to be just sort of better all around, a little more tepid in terms of the inflation situation, and they're willing to take time to get there. And I think that's important as well. That's what the market has been so hard to adjust to, is that a rate cutting cycle when you're not stimulating is not the same. And that's exactly what we're experiencing right now.
Oh, well said. That's a great place to end it. Diane, always great to talk to you. Diane Swong, chief economist at KPMG. A closer look here at that CPI report that we got this morning. Driving stocks now down 2 session lows. A lot more coming up here on the big program as we count you down to the close. Ken Cancel going to be joining us, president and CEO of Churchill Asset Management, about why he says it's still a Goldilocks era for private credit.
Plus, you're going to hear from our conversation with the head of Seaman Energy North America about how they're tackling the national shortage in power transformers. It sounds nerdy, but it's really cool.
All right, also cool. We're going to get some earnings after the bell. Airbnb. Among the companies reporting today, we're going to break down the numbers, what to expect, and of course, full coverage when it crosses the wire. Stick with us. This is The Close on Bloomberg. Well, as we count you down to the closing bell, we do have a focus on the closing bell, literally. Down at the NYSE, our next guest is going to celebrate the recent listing of Nuveen Churchill Direct Lending Corp. It invests in senior loans to private equity-backed middle market companies. It's a market that's seen rapid growth in recent years and is expected to head even higher in 2024. For more insight on that, on private credit, and, well, maybe a lot more, let's bring in Ken Cancel, president and CEO of Churchill Asset Management. He's down there on the floor of the New York Stock Exchange. All right, a new listing, and honestly, Ken, this seems like a pretty big milestone, I think, for a lot of these sort of middle market lenders, if you will, that, let's face it, 10 years ago, 15 years ago, wouldn't even be listed on a stock exchange.
Absolutely. Well, Romaine, it's great to see you, and obviously, Alex, good to see you as well. It is, and I think it's representative of a continued trend toward, individual investors getting access to what historically has been more of an institutional asset class, and I think it speaks to the democratization of private credit and the opportunities that are being brought to individual investors to participate, obviously, in a very attractive area these days.
You talk about the democratization of private credit. We've seen this industry really expand, and you sort of allude to this idea that the traditional investors that were sort of the backbone of this industry a few years ago has now started to shift to more family offices, more individual investors. How much further do you think this is going to go in terms of attracting, a different class of investors than what we would normally think of associated with private capital?
I think it has a lot further to go. I mean, if you look at the development of the private credit asset class, and you're absolutely right, certainly over the last 10 years, the story has been the institutionalization of private credit. But I think as strong managers have demonstrated performance and track record and have shown their ability to deliver strong returns for investors, individual investors have taken notice and see this as an opportunity. So I think it is a long way to go. If you look at, our ability to generate attractive risk-adjusted returns, to generate those returns over an extended period of time through economic cycles, I think it presents tremendous growth opportunity for the industry. And I think that the better managers, the ones that have performed with institutional backing, I think will be the ones to be successful in the retail and the wealth channels.
Ken, I love that you mentioned economic downturn, looking at a day where the S&P is off by 2%. Some critics of private credit would say, hey, it's not really been tested in a deep, deep downturn. We don't know what the hidden risks are, et cetera. What do you say to that?
I would say that the largest scale managers, the firms that have performed now for well over a decade, have in many respects been tested. I mean, if you look at how private credit performed during COVID, during obviously a much more a rising inflationary environment, I think you've seen the top managers perform quite well. And certainly we as Churchill as a firm have been investing now for 18 years. So we invested through COVID, we invested through the rising rate environment and the current dynamics, and we invested back through the GFC as well. So I think private credit is here to stay, and I think that the performance of the largest managers that do have a 10, 15, 20-year track record has borne that out. So I think for the large, more experienced managers, I think you can look back pretty far and see that performance.
So Ken, I have to wonder what the adoption you think is going to be for like the regular investor like me. Is it going to be a large part of my portfolio, a small sliver of my portfolio? How do you see that evolving?
It's interesting. I was talking to one of the senior folks at Bank of America the other day, and they were saying that their average client typically is invested, less than 5% in alternatives. And private credit only being a portion of that. So, I think that, there's an argument to be made that alternatives for an individual investor representing 10 to 20% of their portfolio is not unreasonable at all. And certainly private credit would have a place, in that portfolio. So I think, if you just look at the transition from less than 5% to as much as 10, 15, or even 20% of an individual portfolio, I think you've got a tremendous amount of runway there for the growth in private credit and for alternatives more broadly.
I am curious, in the here and now, Ken, there has been some concerns here about the length of time that we've been seeing the holding periods basically being extended much longer, particularly in some of the buyout funds, and even to a certain extent in some of the other funds as well here. Are you getting a lot of pressure or hearing about a lot of pressure coming from limited partners and other investors, curious about when they actually see a payoff?
Well, if you think about the nature of the alternative investors, the institutional investors that we serve, they are fundamentally less concerned about short-term liquidity. So for our large parent company, TIAA, or other investors like them, they're investing for the long term. They're investing to support the retirement needs of their members, their participants, whether it's an insurance company, a pension fund, or even a sovereign wealth fund. So I think that those institutional investors, are accustomed to less liquidity and are really looking at the longer term dynamics. So the short answer is, we have not seen any pressure at all in terms of holding periods or longer duration investment periods. In fact, if we can generate attractive returns over a longer period of time, that's exactly what our investors are looking for.
All right, Ken, going to have to leave it there. Great to catch up with you, and congratulations. We'll be keeping an eye on you about 45 minutes from now. He'll be ringing the closing bell there down at the NYSE. Ken Kinsell, head of Churchill Asset Management, on a day where we have a new listing, Nuveen Churchill Direct Lending Corp. All right, we do have some breaking news. This is involving ESPN and its relationship with the college football playoff. We're now learning that the two organizations have agreed to a 6-year, $7.8 billion extension. This basically means that the college football playoff will now continue on ESPN and its other properties through the 2031-2032 season. This is according to a report from The Athletic.
I can't keep track of where things are, when, at what time. Anyway, I need like a smart TV to help me with that. Speaking of, Walmart is in talks to buy TV maker Vizio for more than $2 billion. This is according to the Wall Street Journal. Vizio stock has been halted a few times. Now it's jumping 23%. Roku is down on that news. Basically, Walmart already sells a lot of Vizio TVs, and they want to be able to do more and then put a lot of advertising on those kind of TVs as well. So sort of ramping up the kind of partnership that they have there. So could happen for about $2 billion. This is the close on Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we're going to start off with Children's Place. B. Riley cutting the youth apparel retailer down to sell, the price target at 4. The analyst Jeff Flick saying he's not fond of the company's financial situation, says there's limited availability or visibility, I should say, right now on that main credit line at a time when the company is in dire need of funds to offset what's expected to be a lackluster spring quarter. Children's Place shares having one of their worst days on record, down 33%. Next up, let's take a look at 2U. Disappointing investors after the online education platform flagged substantial doubt about its ability to continue as a going concern. This caused analysts over at Needham to change their recommendation to hold until there's better visibility on 2U's ability to refinance its hefty debt load. Those shares having an awful day, down 58% on the day. And finally, United Airlines also moving lower, a downgrade to neutral over at Redburn Atlantic, with the analysts not happy with the broader airline sector, citing a decline in earnings and slower demand for air travel. He also expects the outsized pricing power airlines have enjoyed, well, that's going to finally wane here in 2024. Shares taking a leg down big time, 4% lower on the day, and those are some of our top calls. We want to stick in the travel space here and talk a little bit about Airbnb. We're expected to get their results after the bell tonight, and it's expected to be yet another quarter of slower revenue growth. Investors will be looking for clues on travel demand and what new services are in motion to, well, spice up the user experience. Jed Kelly joining us right now, Managing Director and Senior Equity Analyst at Oppenheimer. He's got a market perform recommendation on Airbnb. All right, Jed, let's get right to it. I mean, we kind of know, at least based on Wall Street consensus, that slowdown in growth certainly persisted in the most recent quarter. Do you have any hope that we're going to get some commentary out of the company that that slowdown is over?
I think one of the things you've got to realize is the reason the stocks they are guiding for slower growth, but the third-party data has been trending a little bit above the street, call it by 2 to 3 points. So there is a potential that you actually could start to see accelerating nights after you get past 1Q. That's kind of the last wonky COVID comp.
Right.
So you could actually see them talk to improving demand. I actually think that's what a lot of the buy side is expecting, given that the stock has held up this well going into tonight's print.
Okay, so potentially a little bit better on the demand side. What about pricing and pricing power? How much, does Airbnb have at this point?
Well, you got to remember, Airbnb doesn't set the price, right? The host sets the price. However, the value of the value of Airbnb is they have a lot of unique inventory on their platform, and the hosts are basically just using Airbnb, and the guests see as a place on Airbnb, they can't find it anywhere else. So on the commission rate, Airbnb probably does have a little more pricing power than some of their peers. That's what we saw about 2 weeks ago when they were able to raise the cross-currency fees, right? Mm-hmm. We actually think if you're shorting the stock, it could be a little difficult because we think they have a lot more underlying take rate levers to push that could potentially raise their commissions.
So when we take a look at, say, Expedia, for example, Jed, and I know it's not a one-for-one comparison, but we knew they had a weaker Q1, but it did look like the back half of this year was going to be weighted towards growth. Is it we're going to see something similar with Airbnb?
Yeah, 1Q is the toughest comp in travel for the online travel companies, given that you're comping a lot of the international Omicron tailwind. So I think what you're seeing is a lot of the demand trends they're speaking to is going to be back half weighted. The other thing you have to remember that's kind of unique to Airbnb and Expedia is the U.S. short-term rental market had very difficult comps, or had slowing growth last year because a lot of people were going over to Europe, and those were the early COVID winners. We think the travel trends normalize, and Airbnb and Expedia's Vrbo in the U.S. are going to have favorable comps. So that's another reason for some of the back half acceleration.
The stock just hit like a 52-week high like yesterday. So what's the downside potential, particularly as we're in this tough tape?
I mean, it's tough to call quarters, and if
But
they
it's
come
my
in,
way of asking, Jed, like what's actually priced?
what's actually priced in. I think right now the street, I think investors right now are expecting nights to come in 2 to 3 points above consensus for room nights, which is about 11%. The stock down, if the stock comes in there, it probably trades down.
All right, Jed, thanks a lot. We appreciate it. I know you got to get to your desk. Thanks a lot, Jed Kelly over at Oppenheimer. I'm just looking at these markets remain. The Russell down the most since June of 2022. The S&P down the most since December of 2022 at one point. And the NASDAQ falling the most since October of 2023. It is ugly out there.
It is ugly out there, and it really raises the question here as to just how much of that sort of rate cut narrative had been priced into equities. We saw the sort of the reversal already in the Treasury market, certainly on this day. I mean, 18 basis point higher on a 2-year, but apparently, at least based on the price action today, that wasn't reflected in equities, because that's a huge move.
Because we had seen a sell-off in the bond market over the last few days / weeks, right? We hadn't seen that in the equity market. And if anything, positioning was very one-sided. In fact, if you look at the skew, there were just so many calls being bought versus puts if we were just kind of primed for this. Anyway, coming up, Seaman Energy is expanding its manufacturing presence in the U.S. It has some political, state ramifications. It's all about alternative energy. We're going to talk to Rich Verborg. He is president of North America about this new investment. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
You find it's funny?
I do find
You're like, it's funny because...
Yeah. I'll let you in on this joke a little bit.
Oh, okay, great. I'm Alex Steele. So, guys, the market's really tough out there. You got to sell up in treasuries. I mean, not if you're long equity markets. You're feeling a lot of pain right now, especially if you weren't buying any puts. Equities are just tanking at this point. Around the lows of the session, you've got a big sell-off happening in the treasury market. And we're actually breaking some technical levels. We're very near to technical levels in the bond market, so it could be pretty ugly. Yeah,
pretty ugly. Not only are you seeing that in the bond market, but, of course, the big jump that you're seeing now in the dollar and, of course, volatility measures also spiking here. The VIX right now at 17.5.
All right, well, one company that we're watching right now is Seaman Energy. So you're looking at a chart of Siemens. Siemens owns a big part of Seaman Energy, and Seaman Energy announced an expansion of its operations in Charlotte, North Carolina today to produce transformers. That's basically equipment that connects renewables to the power grid. And shocker, there's actually a shortage of them, and this would be the first site in the U.S. to do so. And we sat down with Rich Verborg. He's president of North America for Seaman Energy about why they're doing this now and why in the U.S.
First of all, every power that comes out of your wall, that you plug your toaster in, that you turn your lights on, goes through a transformer, because you take the power that comes out of the equipment, whether it be wind or solar or even gas turbines or nuclear, goes through a transformer, gets the voltage at the right levels, transfers it over to your house, and then you have other transformers that step it down from there. So this is the challenge that we see is if we're not making transformers here in the United States, we're relying on external. And basically 80% of the transformers that we install here in the United States are made overseas. So it's important that we've got U.S. content in here to make sure that we don't get caught up in any supply problems overseas or transportation logistics issues of bringing those from overseas here to the United States. And that's why we decided to build them here in Charlotte.
Are the policies right now here in the U.S. supportive of that? I know there were some provisions in the IRA, and of course you guys have a lot of experience with the regulations over there in Europe, which have been supportive of these types of projects.
Yeah, definitely. The changes, what we see in the support mechanisms, whether it be the IRA, the BIL, or even some of the state incentives, we see a lot of that really starting, first of all, to grow the grid, grow the energy transition, accelerate the energy transition, but also accelerate the grid capacity. And we're excited about seeing that. And that's why we feel now is the right time to build these transformers here in the U.S.
Rich, so you're taking advantage of state policy, maybe federal policy, et cetera. Without that, is the project economic? Because some might be looking towards the IRA in 2024 after the presidential election and be worried that those subsidies might not be there anymore.
Well, that's always a concern. When you look at, we've got to make sure we've got the demand side so that our customers are asking for these transformers. And as things change within the IRA, we've got to make sure that our demand is continuing. But we believe that demand will continue because we see the energy transition as a transition which is going to be needing these components, but also we see as an expansion, as a lot of things will get electrified. We see the grid expanding as well as transitioning.
Well, let's talk a little bit about the sources of that energy and how it feeds into those transformers once they are all built here. A lot of questions right now, not only about the commitment to stay by some of these renewable energy projects, but also the cost to Siemens Energy as well as to your competitors, whether it's labor, whether it's the cost of steel, or some of the other components to go into making this. How manageable is that right now?
So the costs are always the costs, right? So as you look at the industry that we have here, we've always got to manage whether it be material cost, whether it be labor cost, and then some of that needs to come out at the end as a price. So that's what we're always working on is the costs and the price that go into it. And some of that is transitioning to our customers, educating our customers that pricing has gone up and pricing will go up even further, we believe. And that's what we see within the industry, that electricity is transitioning. And as we go to different sources, sometimes it's going to be more expensive.
That was Rich Vorberg, president for North America for Seaman Energy. And what I just find interesting, the cost is the cost.
Yeah.
Basically, guys, you're going to have to pay up for alternative energy. And it feels like at some point this is just a broadly inflationary story.
It is a broadly inflationary story, and I understand why he said that, but it also gets to the question, too, as to whether people are going to take that price. And we've already seen the fact that you have alternatives, right? I mean, this isn't just the only game in town anymore. And we've seen that with projects in Virginia. We've seen that with projects here in New York State, where people have really started to reassess whether it's actually worth moving down this road. Look, I mean, if you hand somebody a bill for a renewable energy project that's more expensive than the traditional energy they ever gotten, what do you think is going to happen?
If the government wants it to happen, they're going to have to step in and spend more money.
The government?
Yes.
Oh.
Which is going to be hard then to get rid of the IRA.
Yeah.
And then that just feeds back into the broader, like, okay, this is going to cost trillions.
Yeah.
And governments at the end of the day are going to be on the hook for that. So then what does that do to like longer term bond yields? What does that do to issuance? What does that wind up doing to inflation? Broader consequences that I don't feel like we really understand.
Yeah, and then we talk about just the whole transformers and all that, and just how this is really just kind of a state-by-state, jurisdiction-by-jurisdiction thing. You have no real sort of like a federal program really pushing this right now. All right, definitely something we'll be talking a lot about over the next few days, weeks, and months. And coming up here on the program, we're going to talk with Erica Clower, portfolio manager for PGIM's Jennison Technology Fund. We're going to get her outlook on the tech sector here, valuations, and the potential threats to the tech supply chain. That's coming up next on The Close. This is Bloomberg. The high-flying tech sector, well, it wasn't immune from today's broad-based equity sell-off, sparked by that CPI report this morning, a big downdraft in some of the big names. But semiconductor companies like NVIDIA, like ARM, well, they're still holding on to big gains on the year. Geopolitical risk, including tensions between the U.S. and China, still represent a threat to crucial supply chains that the sector depends on. And it makes an interesting backdrop here for whether this rally in tech stocks has more room to run. Erica Clower joining us right now, portfolio manager for the PGIM Jennison Technology Fund, to talk about her outlook for the technology sector. Erica, great to see you.
Thank you so much for having me.
You know, everybody right now is so obsessed about valuations, or at least their perception of valuations here. When you look at the run-up that we've had in some of these big names here, did it seem justified?
Look, you know, the magnitude of the upwards earnings revisions we've seen in some of these companies has been astonishing. Case number one would be Advanced Micro Devices. Before the beginning of the year, they dimensioned their AI opportunity at $2 billion for 2024. They've now upped that number to over $3.5 billion, and it looks like there could even be some upside to that. So certainly the upward value movements in the expectations for earnings justifies higher valuations, but I think also it's to be expected that we should see some consolidation of the gains.
Okay, and maybe at least for today, we're certainly getting that. Whether that plays out, though, longer term, I guess it depends on your view of AI and all the sort of other technologies surrounding it. How much of that is going to actually be a contributor to the bottom line? I mean, we know there are certain companies out there where it's just a natural fit, right? You know, NVIDIA is going to sell the chips for it, and ARM maybe makes, the machines to help make that. But what about the other companies? What is the value proposition there?
So at Jennison, we do take a much longer term view on the prospects for these companies throughout the supply chain. In fact, we wrote a pretty detailed white paper on this that has received some very strong reception from the entire technology community. What we articulate is that it's not just the chips, but it's also software, it's infrastructure, it's data centers. There's an extraordinary opportunity to see significant earnings power from many companies that are really enjoying this transition to accelerated computing.
Interestingly enough, though, if you look at, say, NVIDIA, they're only down like 0.5%. Like on a day where it's a tough tape, like some of these guys are really holding up. So we were just talking to the Seaman Energy North America president about building transformers to connect to the grid in the U.S. Same kind of thing with having to build chips in the U.S., manufacturing in the U.S. How long does that take? And like, how do you as an investor play something like that?
So this is a terrific question. And actually what we found with our holdings at Jennison, which we've had for years, for a company, for example, like a Lam Research, they are the companies that make the equipment that make chips. These companies have 12, 18, 24-month lead times to produce these pieces of equipment that are millions and millions of dollars. And so they really have quite a good line of sight on the longer term view of how many chips are going to be required to build out this entire ecosystem. I think for these types of companies, they can continue to grow their revenues in excess of 20%, and of course, more importantly, profits even faster than that, because the more advanced the technology, the higher the price premium is that are put on these very value-added systems.
Well, that's kind of my next question in terms of that growth rate, right? Like, can you keep growing at 10, 20% every quarter, every year? Like, is that a realistic expectation? It sounds like yes.
So the answer is it really depends. Our mandate at Jennison is really to look at the longer term prospects and figure out those companies that can sustain those types of growth rates that you mentioned. There are certain companies that are more mature and are not seeing the pricing power that we would expect to see in our core holdings. But for companies like Applied Materials, Lam Research, ASM Lithography, and certainly NVIDIA, when we look out over the long term and we map out what we think the revenue growth is going to be, we come out in some cases double or even triple what the consensus looks like. Or alternatively, we find that on a longer term basis, we're some of the only people that have estimates published for those companies.
There's a lot of promise there, certainly from the corporate side. I do wonder about regulations, geopolitics getting in the way of all this. We know the U.S. and China obviously at odds over what technology should be shared with whom. Do you worry at all about that potentially disrupting this trajectory?
This, I think, is the best question because it's actually the thing that keeps us up most at nighttime when we look at the tensions between the US and China, when we look on restrictions of what technologies can be sold into China, we see this as potentially hampering technological development and innovation. Because if you think about it, there are incredibly innovative companies in China that now simply don't have access to leading edge technologies, whether it's lithography equipment, whether it's semiconductor etch equipment, or even software tools. So this is something that really is something of concern. You also think about what it is to have to duplicate all of your efforts instead of just having one plant in one low-cost area.
Right.
In order to diversify against geopolitical risk, having to make things in two different disparate places is by definition a higher cost proposition.
All right, Erica, great conversation. We're going to have to leave it there. Erica Klauer, portfolio manager for the PGIM Jennison Technology Fund. Stick with us for 14 minutes until we get to the closing bell. A fuller breakdown of all the market action with stocks at session lows. This is Bloomberg. This is the countdown to the close. Romaine Bostic alongside Alex Steele with 10 minutes until we get to those bells, Alex. The good news is we're off the lows of the day. The bad news is we're still deep in the red.
It's still a brutal day. I mean, the superlatives for the Russell, for the NASDAQ 100, and for the S&P are all pretty dramatic. Although I pointed out earlier that NVIDIA is only down 0.5. So those really big, high-quality tech names are still definitely outperforming. The 10-year yield is down, up by 13 basis points, really kissing that 100-day moving average. But I just really wonder what happens when we come in tomorrow. Like, is this the dip investors were waiting to buy?
That's a big question, though. I guess if it weren't for that CPI report, I'd probably say but this might be the game changer.
Small caps will be up. Who knows?
I mean, remember, it was a really hot CPI print that we got this morning, and it's forcing a lot of folks out there to really rethink the path of Fed rate cuts. You're already seeing that, of course, in the swaps market, and we had a chance to catch up with Diane Swong earlier at KPMG, who gave us her outlook for the year.
We only have 3 rate cuts this year, and that really is sort of consistent with what Jay Powell had said at the press conference in January, and that was the dialing back of restrictive policy. This is not rate cuts to stimulate the economy, and the fear is that if they cut too quickly, they could really reignite the cooling embers of inflation.
Speaking a little bit earlier there with Diane Swong, Anthony Saglambeni joining us right now, Chief Market Strategist at Ameriprise Financial. And Anthony, I think this report we got this morning took a lot of people by surprise, but should it have taken them by surprise?
No, I don't think so. I mean, economic growth has been very strong to start out the year. We've had very strong employment. We got Atlanta Fed GDP now for the first quarter tracking at 3.4%. And I don't think the path lower inflation, I don't think it was reasonable to expect that would be a linear decline, particularly that last mile. But the market's had a rate problem for the last couple months. And, today's inflation report probably takes a Fed cut off the table, not only for March, but probably May. Our view has been very similar to your last guess, where, we see about 3 rate cuts this year. And I think that is supportive for the market as long as earnings growth is moving higher. And today's decline is pretty orderly. You're seeing small caps come down, interest rate sensitive sectors come down. Those areas that were really anticipating more aggressive rate cuts this year, those are the areas that are getting hurt. And the areas that have very strong profit growth, like technology and big tech, they're not down as much. And I think it makes sense given what we saw in the CPI report today.
Well, then I'll steal Alex's question that I think she posed in the previous thing, which is, are we going to see maybe some folks willing to buy the dip, at least when it comes to some of those higher quality tech names?
Yeah, the trend over the last couple months, particularly since the October lows, is these pullbacks have generally brought in more buyers, and you've seen stocks gravitate higher. Question is we haven't really seen a 5 or 10% correction in the last couple months. That's typically normal. A lot of the technicals have been overextended for the last couple months, and so there's room for the markets to pull back a little bit, particularly in some of those really high growth big tech names. But there's $6 trillion sitting on the sidelines, and I think there's a lot of investors that have missed this rally over the last couple months that would likely like a 5 or 10% pullback to maybe get more on side in their portfolio, at least in terms of stocks.
That's why I'm really interested to see what happens tomorrow morning when you wake up. You look at futures. If you look at them now, you'd be like, oh my gosh, forget it. We're going to be out to bed tomorrow. But I feel like it could be different. Does that money, you think, go into the safety, quote unquote, of, say, big tech, or does it go back to small caps that had been the trade the last few weeks?
Yeah, one of the most interesting concepts that I think gets lost in a lot of the macro noise around growth and inflation is that earnings expectations have been ramping higher for the last year. So when you look at next 12 months earnings expectations, they have been on a steady climb higher. And I think that's been very supportive for the fundamental narrative that stocks can continue to move higher. The question is a lot of that earnings growth is coming in big tech, and it's coming in the areas that have really explosive growth opportunities. And so the rest of the market has not really kept pace. And so the question that we're trying to answer is that in a pullback of 5 or 10%, do things like small caps and cyclical value add more opportunity? And I would say those areas have largely discounted the fact that maybe we don't get 6 interest rate cuts this year, we get 3. And so possibly in a rotation out of big tech, maybe a pullback in the market would include some areas that have not kept pace. Small cap, cyclical value, those areas that maybe have more opportunity if we do see a soft landing.
So it sounds like you do want to go into the cyclicals and small caps. Do you still need to keep big tech, though, to barbell that?
Yeah, I think in terms of earnings growth, you can't ignore what's happening in big tech and AI. And so, at least in terms of our positioning, being equal weight those areas in a broader portfolio makes a lot of sense. But in terms of maybe that soft landing narrative where the Fed is cutting interest rates in the back half of the year, growth is remaining positive, employment trends are positive, that's a real good setup for the rest of the 494 companies that haven't really gone anywhere over the last year for their profit growth trends to improve. And so I think if you buy into the narrative that inflation will move lower over time, which we do, and profit growth will accelerate over the course of this year, then I do think there's a lot of areas that pose opportunities outside of big tech that maybe perform a little bit better this year if the Fed is cutting rates later this year.
Have you been encouraged, Anthony, by the earnings season so far, what we've heard?
Yeah. I mean, I think in terms of net profit margins, they've held for this year, or they've held for the previous quarter. You're seeing cost-cutting initiatives across companies. So while that's not really growth exciting, they are maintaining growth. A lot of companies have said or mentioned that they still have some pricing power, and the economy is still strong. So consumers have been resilient. Earnings growth in big tech has been pretty positive, and I think there's opportunities for that earnings growth to improve in some of these cyclical areas, things like financials, if rates come down a little bit, materials, industrials, healthcare. These are areas that really haven't kept pace over the last 12 months. And if their trends improve and the consumer and businesses remain resilient, there's opportunity for these stocks to outperform.
All right, gonna have to leave it there, Anthony. Always great to talk to you. Anthony Saglin-Benny, Chief Market Strategist at Ameriprise Financial, helping us count down to the closing bells with less than 3 minutes to go, Alex. And if you put up an intraday chart of the S&P 500, you know what you're gonna see? It's a massive dip buying, really, just in the last few minutes here. In fact, we're up about 30 points on the S&P 500 since about 20 or 30 minutes ago here. Still down 1.5% on the day, though.
Yeah, you saw it around 10 o'clock.
Yeah.
You saw some dip buyers come in, and then we kind of rolled over. We were going to pick up some steam to the downside, down 2%, and no longer, just down 1.5%. It's just the money's still there to be bought.
It is, and not only are the prices going up, but so too is the volume. Maybe that is the setup for tomorrow. If you stick with us, we'll have a full breakdown for you of all the market action as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio originals, our partnership with YouTube on a very consequential day for the markets, which started with a big CPI report, a big jump in Treasury yields, and a big drop in equity prices.
Yeah, absolutely. We saw, once again, another major market reset when it comes to expectations about what the Fed will do in terms of rate cuts, more like later rather than sooner. and you're seeing it play out. What I find remarkable, guys, is even with this correction that we're seeing, or not even technical correction, but move down in stocks, you still have a NASDAQ 100 that's up more than 4%. You have an S&P that is still up about 3.5% for the year. So still some significant moves year to date, even with the selling we're seeing today.
Yeah, on the equity market, off our worst levels of the day, which we're down 2% on the S&P 500, down 1.4% right now. But Alex, I was thinking all day about what you said yesterday about the rates market and your comment yesterday that bonds did nothing. And it's almost like everybody heard you because today the story is all about the bond market.
So much credit. I have so much power. No one listens to me. What are you talking about, Tim? But
yes, we do.
No, but I think the point is, if you buy the dip, Romaine, do you buy it in just tech? And our cyclicals and small caps we put on the side right now as we re-rate the bond market yet again?
Yeah, it's hard to know, but I do have a sense that it's probably going to end up being the Magnificent Seven or Magnificent Six, whatever is sort of the new nomenclature of the moment. But look, people gravitate to safety, and those stocks offered a lot of safety. As we get to the closing bells, and we should point out, we have several consequential earnings coming after the bell tonight, so stick with us. That includes Robinhood, MGM, Zillow, Lyft, and Airbnb. Let's go through the numbers here with the Dow Jones Industrial Average looking to close the day down, 524 points here. That's down by about 1.4%. We should point out it could have been a lot worse. Similar story for the S&P 500, which is down about 1.4% on the day, right around 49.53. At one point, it was down as much as 2% on the day. The NASDAQ Composite going to close out lower by about 300 points or 1.8%, but your big laggard on the day, that was the Russell 2000, is going to finish the day lower by about 81 points or 4% lower than where it started.
Yeah, not really many places to hide in this market. You look at the S&P 500, Romaine, 451 names to the downside. As we say this, though, earnings crossing the Bloomberg.
Akamai earnings crossing the wire right now. Those shares moving lower and after hours trading down 12% here, with fourth quarter revenue coming in a little bit light. $995 million is what the company is reporting. What the street wanted to see was $1 billion on the nose. Did not get that. Adjusted EPS, that actually was a beat, coming in at $1.69 a share. The street was looking for $1.60. So basically a little bit of a miss on revenue, a little bit of a beat on adjusted EPS, but the net effect of it is investors don't like what they see. Shares down 8%.
Also, tough tape to get into today. Speaking of just overall, if you look at the IMAP, everything red. There's like a sliver of something green, but I don't even know what that is. Everything red. It was a pretty ugly spot.
Yeah, no doubt about it, right? It was a tough one. And that's why finding gainers, not so easy. But luckily for JetBlue, kind of holding on to its gains throughout the session, up and pretty much finishing at its best levels of the day, guys. JetBlue up 21%. You know the story. Iconic activist investor Carl Icahn revealing a new nearly 10% stake in the company. And this is making him, according to Bloomberg data, the third largest shareholder. Seems like he's looking to, I think, maybe get a seat or maybe some board seats. It's not immediately clear in terms of what he's wanting, but this stake happening as JetBlue, that carrier's new chief executive officer, Joanna Garrity, took over.
Can I just interject, though, too, because Alex was asking what that little green sliver was, so I had to look it up. Commercial and professional services, which is largely waste management, which rallied 6% on the day. Never a good day when waste management.
If you had waited, in terms of my gainers, were two companies among sanitation.
I'm sorry, Carol. Did I step on your toes?
You did. Waste Management, your number two gainer.
I got to start going to these meetings. I didn't know what you were talking about.
Reported fourth quarter adjusted EPS ahead of expectations. Company issued a full year adjusted operating EBITDA guidance that beat estimates. Basically garbage. Doesn't matter what the economy does. Ecolab is also your number one gainer in the S&P 500 food sanitation company. Biggest intraday gain, I think, since around November 2020. And this company forecast adjusted earnings per share for the first quarter. They beat the average analyst estimate. So garbage.
Do you have any
apparently.
others?
Say no more.
Okay, so can I mention another one real quickly? Zoom Info also had a great day, up about 14%
I
here.
wanted to give that to you.
Oh, thank you.
You're very welcome.
Thank you. You're so generous.
I am.
So garbage and Zoom.
Okay, well, let's talk about the Mag 7 or the Mag 6, whatever we're calling them these days. Whatever we're calling them, they really led losses in the S&P 500 on a points basis today. In fact, they were the worst performers, all 7 of them, or 6 of them if you want to count 6 of them and take Tesla out of there. But it was up there. I do want to focus on Microsoft, though, finishing the day down by 2.15% on the day. At one point, it was at its lowest levels. It was the worst day since October 2023 in terms of intraday. Let's talk about Avis Budget, ticker CAR. Shares fell as much as 24% after the company's fourth quarter revenue and adjusted EBITDA missed the average analyst estimate. Shares falling on the day 23%. On top of that, the inflation data that we got earlier today, it showed the cost of vehicle maintenance, also the cost of repair rose and prices of used cars drop. Both of those things, bad news for Avis Budget and for its peer Hertz. And finally, shares of Roku took a dive after the Wall Street Journal reported that Walmart is in talks to buy the smart TV manufacturer Vizio for $2 billion. This a play on the data that this TV company has.
All right. So in a very down day, you've got Robinhood shares rallying about 8-9% here in the aftermarket. Let's get to some of the numbers just crossing. Fourth quarter net revenue, $471 million. That's above street estimates, folks, of $457 million. Fourth quarter transaction-based revenue, $200 million. That, too, better than what the street was expecting. They were expecting strong numbers. We had a lot of positive equity moves in that last quarter. The estimate in terms of transaction-based revenue, as we said, coming in at $200 million, 191.2 was the estimate. Sees 2024 total operating expenses a little bit lower. 185 to 195 billion, giving a bit of a range. But again, fourth quarter net revenue, that's a beat, and the street's liking it, remain up about 10%.
Well, I just want to go back to the cost thing, because I saw in the quarter, those operating expenses were down 17% year over year. And we should point out, though, actual operating expenses rose, but it was actually apparently a lot of the share-based compensation that led to that drop in operating expenses on the quarter. Tim.
Let's talk Lyft. Shares of Lyft are moving higher in the after hours right now. This after the company announced gross bookings came in above estimates at $3.72 billion versus $3.67 billion. Fourth quarter revenue came in exactly in line with estimates, but fourth quarter adjusted EBITDA was a big beat, $66.6 million versus estimates of $56 million. Fourth quarter rides coming above estimates as well. Active riders also coming in slightly below estimates at 22.4 million. Lyft shares up whopping 6.8%, kind of bouncing around in the after hours, up about 4% right now, Alex.
All right, let's get to Airbnb. Here's the headline: buying back up to $6 billion of shares, Class A common stock. They're looking at the first quarter revenue, and this was the one that I already kind of guided down to be a little weaker potentially, especially if you look at Expedia. First quarter revenue on the high end coming in $2.07 billion. That's actually better than estimates. For the fourth quarter, just overall, you're looking at a little bit stronger revenue, gross booking value for the fourth quarter, also coming in a little stronger than estimated. Experiences booked a little bit stronger than estimated. Margins a little bit stronger than estimated. You're hearing a theme here. But that first quarter revenue outlook also better than estimated, plus that buyback.
Yeah, that's a big deal, right? And this is a stock that's already been outperforming this year, up almost 11% here in 2024. And so, we wonder, are people still wanting to experiencing things? I would say it certainly was playing into the fourth quarter. It'll be interesting. First quarter revenue, so giving a little bit of an outlook there, $2.03 billion to $2.07 billion. Estimate is $2.02 billion. So remain in terms of, they're pretty upbeat that people are going to still want to do some traveling here.
Hey, and they even threw in a comment about AI for you guys there. They're deploying AI across all of their services, and that includes the large language models. Basically, that folds back into that game planner project that they've been working on here. And the idea, at least according to them and what they've said on previous conference calls, the idea that this makes that experience better, at least relative to some of their competitors. Like, what's the favorite one you had? Was it Expedia that you
Vrbo?
Yeah, that's Vrbo.
Hey, is this a company where you can still work from anywhere if you work for Airbnb? Like they're still like leaning into the completely remote work, Alex? The CEO says, okay, well, we're Airbnb, so we're going to set the example that you can work from anywhere.
I have absolutely no idea.
You do, but it has to be an Airbnb.
You have to be an Airbnb. Exactly.
That's true, but look at that stock move, up about 9%. Guys, when you buy back stock up to $6 billion and you beat, that's called lowering expectations and then beating, and then you get a nice buyback.
Hey, did we do Lyft? It's just
we did do that.
Yeah, we did.
Okay.
I did it, Carol. I know you don't.
Sorry.
I know you don't pay attention to what I say.
It's up 7% too in the aftermarket.
And before we go, we should point out Instacart shares are plunging right now. Those results also crossing the wire here. Hard to get the comparison here as the website is not loaded, but the results are out. Shares are down.
All right, guys, but some market action here and some good. So we can see that even in a downward market trend, you can see some of these names bucking, certainly in the aftermarket. All right, that's a wrap, a busy one. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, we call it Beyond the Bell, folks. We will see you same time tomorrow.
All right, stick with us. We're going to break down all of the earnings for you when we come back after the break, and we're going to have a conversation with the CEO of Invitation Homes, Dallas Tanner, going to be joining us in just a bit. Stick with us. This is The Close on Bloomberg. All right, bonds are way too expensive if you believe that the fight against inflation is far from over. At least that was a sentiment on Wall Street today. A 16, 17 basis point move higher on that 2-year yield to start the day. And of course, that came with the start of the day and a CPI report that came in hot. Core prices higher than expected, super core prices moving at a faster pace than expected and raising a lot of questions about whether all those rate cuts priced into this market was wise. Indeed, the S&P 500 lower by about 1.4% on the day. Second worst day for the S&P 500. We should point out it could have been worse, down as much as 2% at one point on the day, but it was those economically sensitive names like the Russell 2000 down 4%, home builders like Lennar down about 4%, and even names like Valley Corp and some of the other regional banks also moving lower here on the day, an 8% drop there on the day. You also saw some of the other economically sensitive sectors, including solar stocks, move lower. TAN, that's the main ETF tracking the solar stocks, down about 6% here on the day. And take a look at Avis Budget. You had a lot of names like this. This gets into some of those high-value names with questionable balance sheets and whether they can survive a higher for longer rate environment. Now, it wasn't all gloom and doom out there. You did have some bright spots. JetBlue getting a nice bid, 22% higher here on the back of that interest by Carl Icahn, and Zoom Info Technologies also a pretty nice bid, 14% higher here on the back of a relatively decent earnings report. But it does bring us back to, well, I guess we'll call it the question of the day. Alex Steele posed this a little bit earlier in the show. Are we going to see some big dip buying tomorrow, particularly when it comes to some of those big cap tech stocks? They have been the ballast for this market. They have been, well, the comfort zone for this market. But valuations, at least by traditional measures, are stretched. The white line here, what you're seeing is basically the S&P tech sector overlaid with the S&P 500. And you can see the differential in valuation, 8 points there. And even when you take something like the Philadelphia Semiconductor Index and put it up against the S&P 500, you're still talking about 6 to 6 points on that level as well. That is the setup here. But this chart might not mean anything to you, particularly if you buy into, well, some of those theories that the way we've been valuing things might be all wrong. I think our next guest has some thoughts on that as well. And we should point out, before we actually get to them, we are getting some earnings crossing the wire on Instacart. Those shares have been oscillating quite a bit here, now down about 8% here in after hours trading. We should point out that on the numbers that came out of the fourth quarter, on EPS, on adjusted EBITDA, as well as gross transaction volume, those all actually beat Wall Street estimates. However, some of the guidance they gave came in maybe a little bit light, particularly on the high end of the range that they gave. Maybe that's the reason why you're seeing a little bit of softness there. Now, I do want to go back to that valuation question and bring in Meb Faber. He's joining us right now, CIO over at Cambria Investments. Meb, a lot going on today, and it's a great day to have you because this really was, to a certain extent, not just a sell-off around inflation, a sell-off around changing expectations around the Fed, but it was also a rethink about market valuations.
Yeah, tech stocks, no question, have been rocking and rolling this year, last year. And if you're a value guy like me who likes cash flows, who likes companies that pay out through dividends and buybacks, there's not a lot to hunt for in the United States. And everyone always says, you got to be in tech stocks. You're going to miss out over the next decade.
Okay, well,
the interesting thing.
Well, I'm just going to go there. Meb, if you're not finding tech stocks here in the U.S., where else are you going to find them? I thought we were the only game in town.
If I was to tell you, Romaine, I'd say, look, do you know there's a semiconductor stock that's outperforming NVIDIA since the beginning of last year? People say you're crazy. I say this stock has been mentioned once on Twitter this year. It just so happens to be located in South Korea. Now, we own it. And my whole point is we do a shareholder yield approach, right? Mm-hmm. High quality companies, conscientious about valuations, looking for these distributions. And in the US, that leads you away from tech. We have a single low digit tech weighting in the US. In emerging markets, where stocks are much cheaper on average, the number one sector allocation is tech. And so you have this exposure where the stocks on average are about half the valuation. And that leads you to some places where you can get tech at much cheaper valuations, high quality businesses. Many of these have 5% plus dividend yields, double digit shareholder yields, and you end up with companies on average that are much higher quality, much more priced for, we think, much better future returns than in the US, which, regardless of the exact PE, on average are really expensive.
Is there though added risk that comes with that, Meb, at least relative to what you would have here in the US?
Well, I was gonna cut you off before you said U.S. because I say the added risk historically is buying really expensive things, which on average is a horrible idea. If you look at a lot of the research, you're buying things that are 10 times sales, God forbid 50, 100 times some of the things we saw in the cycle. On average, that underperforms T-bills. And T-bills now are 5%. That's not so bad. So looking for that margin of safety, you can find, yes, you can find great companies in the U.S., single-digit PE ratios, low debt, high quality, paying out these double-digit shareholder yields, but they're not in the tech sector. You're in places like energy, industrials, materials, financials. So you have to be sector agnostic. If you're not, you say, you know what, Meb, no, I'm a tech guy through and through. Well, look beyond your borders. There's great companies everywhere. Look in Taiwan and Korea and elsewhere. And you can find some pretty interesting stocks that Wall Street's not talking about, Twitter's not talking about, that have a lot of upside potential, and they're not 2 trillion in market cap. You know, they're going to be a lot smaller, and it's a lot easier to have 5, 10 baggers when you're only single-digit billion than when you're single-digit trillion.
Are some of those names that you're interested in? I mean, you mentioned the semiconductor company in Taiwan. I assume you're referring to Hanmi. But we talk about this idea of whether this is a global story or whether those types of investments are going to be much more specific to the Korean or Asian markets as opposed to that global story that a lot of investors have been trying to sort of suss out, whether it's through NVIDIA or ARM or something else.
Yeah, I think borders are becoming increasingly meaningless here in 2024. Capitalism doesn't really know any bounds. And if you have some companies that have some advances in great technology and products, it doesn't matter where they're located. So on top of that, we think that the US dollar is overvalued. I just got back from Asia, and the dollar goes a lot further than it did a few years ago. We think that's going to be a tailwind. So you got probably a 20% overvaluation versus some of these countries' purchasing power basis. You may get that tailwind for foreign emerging. Now, look, this story has been U.S. only all the way back to the GFC, but you go back the 100 years prior, and it's usually somewhat of a coin flip on what country does best. And right now, this has been one heck of a run for U.S. stocks. But we think, particularly emerging markets, there's a lot of opportunity for many of these tech companies, and broadly speaking as well.
What about on the debt side? I mean, you mentioned T-bills here in the U.S., which still pay a pretty healthy return right now, at least in terms of the coupon. I am curious about whether you expect that to continue, whether we're still going to see those types of percentage yields, and for that matter, even some of the price returns that were also baked into that.
You know, as a macro and particularly equity guy, there's always been a head scratcher to me, which is hypothetically, if you can get T-bills at 5, in the same way that Mr. Market shows up at your door in the stock market, it's true with bonds as well. And he shows up and he says, Romain, I got some junk bonds to sell you at a 5% yield. You'd probably say, well, that's not interesting. I can just invest in T-bills. I say, what about a 3% yield? You say, you're crazy. Well, you say, okay, well, fine. What about a 12% junk bond yield? You say, now you're talking. That's interesting. And we've done all the modeling, and it shows if you invest in any of these other risky bonds, so once you move away from T-bills, you got term premium, credit premium, you got 30-year bonds, you got corporate bonds, emerging, on and on and on, right? It really only makes sense to invest in them when the spread compensates you. So you can model these historically, and some bonds are less risky, some are a lot riskier. And if you invest in them when the spread is in the top half or top third of history, you end up with a great exposure with that margin of safety. And right now, it's a weird time. So despite the fact that many bonds are already down 10, 20, 40%, which if that was stocks, people would be losing their mind if the stock market was down almost half. Yeah. And that's nominal, so real is worse. Many of the yields don't compensate you yet. So we actually just launched a fund. It's TYLD, Tactical Yield. But it sits there in T-bills and chills. So right now, it's 100% T-bills. And then it looks at all these other bond markets and said, we'll move in you could say when they're distressed, or really when the spread compensates you. So when they start to move out, you'll get back into these markets. But right now, it's signaling not yet. So either T-bills need to come down a lot in yield, or everything else needs to move up.
Yeah.
But right now, the spreads are pretty slim.
All right, Meb, going to have to leave it there. Always great conversation. Meb Faber, CIO over at Cambria Investments here. As we go back to some of the earnings crossing the wire here, fast and furious, let's get you some crossing the wire right now. MGM, those shares moving slightly lower here in after hours trading, despite the fact that it looks like they beat on both the top and the bottom line. Revenue in the fourth quarter, $4.38 billion. The street was looking for 4.14 on average, and the company beat big time on EPS. Adjusted EPS coming in at $1.06 a share. The street was looking for 68 cents a share. We should also point out the company saying that overall its Las Vegas revenue up about 3.2% year over year. Meanwhile, let's turn to the home space here, particularly with Invitation Homes, one of the biggest owners of rental properties in the country. That revenue climbing about 7.7% in the most recent quarter to about $624 million. That would be a beat here based on what the street was looking for. As far as their free funds from operations, that came in at about 45 cents a share. The street was looking for 45 cents a share. Those shares unchanged here on the day. We're going to talk to the CEO in just a minute. But when we come back from the break, we're also going to break down the results that we got out of Lyft, out of Airbnb, Instacart, and quite a few others. That's coming up next here on The Close. This is Bloomberg. All right, results are out for Lyft, Instacart, Airbnb, the sharing economy, or something like that. Mandeep Singh, Bloomberg Intelligence tech analyst, here to walk us through what we learned. And let's start with that big number at the top of the screen, Mandeep. Lyft shares up 33% here in after hours trading. I guess not only a decent quarter, but more importantly, some pretty decent guidance.
And it was driven by ride growth. So I think so far what we had seen in the last 3 quarters was they had single-digit ride growth, whereas competitor Uber, which was 5 times bigger, had double-digit, 20% plus ride growth. Mm-hmm. So Lyft seemed to have shown an acceleration in that trend. I do think, the one metric which investors care about, the user number, that's still kind of flat. So what it shows is probably they're seeing some sort of increased frequency with their existing users. Uh-huh. And that's where, they have lowered their pricing to compete with Uber, and it's reflected in their lower take rates, but it's working in the sense, at least it's driving engagement with the 22 million users they have, and that's what's driving the guidance.
Okay, all right. Well, I don't know. I mean, if it's just more people, the same people just using it more frequently, is that going to be sustainable?
And plus, Lyft has lowered their take rate. So think of, what Uber is taking every ride versus what Lyft is taking. So Lyft at this point is really competing on price to make sure they maintain their market share.
All right. We also heard from Airbnb, and they gave a pretty optimistic outlook as well.
Well, so with Airbnb, we know it's a very profitable business model, and it's 30% plus margins. They announced a big share buyback. I think the one metric that investors may not be too excited about is the room night. That seems to be tapering. It's still 11 to 12%, but in the end, you have to ask yourself, what is the addressable market for a company like Airbnb? Yes, they have a great brand. They're a category leader. But we know vacation rentals is already a big category. They're doing more than 400 million room nights annually. Mm-hmm. How big can that get? And that's where the concern lies is, will that room night growth actually slow? Mm-hmm. So they talk about international being a driver and the fact that there are a lot of first-time people who are renting Airbnb outside the U.S., and that's great. But I think when I compare them to other OTAs that do everything, Airbnb is still a one-trick pony. Yeah. And they have great margins out of that. They have aggregated a lot of supply, but it's still one thing that you are going to the website for.
All right, well, if they're a one-trick pony, I want to get your thoughts on Instacart, Maple Bear. Those shares are down in after-hours trading. It looks like the revenue came in a little bit short of expectations.
Yeah, so with Instacart, again, the problem is how big is their user base. So, look at Lyft, right? The reason why they're struggling is you have got a scale player. Mm-hmm. Same thing with Instacart. Their user base is much smaller than a DoorDash or an Uber. So granted, Instacart has executed very well with advertising, but the fact that they're announcing a job cut,
Yeah.
And, I mean, I don't understand the logic of doing a buyback, when you're announcing a job cut, but clearly there's a lot to prove there. All
right, Mandeep Singh of Bloomberg Intelligence. Instacart shares down about 4%. Airbnb unchanged. Lyft shares, that's your winner here in after hours, trading up about 38%. When we come back from the break, more earnings and a conversation with Invitation Homes. All right, we just walked through the numbers that we got out of Instacart, Airbnb, and Lyft. 3 other earnings crossing the wire as well, including MGM, Robinhood, and Zillow. Isabel Lee, Abigail Doolittle, and Alexandra Semenova standing by right now for a breakdown of what we learned. Let's start with Alexandra and Robinhood.
Hey, Romaine, let's start here with Robinhood. A big move to the upside in after-hours trading after revenue beat estimates. You can see shares up more than 15%. Now, heading into this report, shares were down 7% year to date. Fourth quarter revenue came in at $471 million. That's above Wall Street estimates of $457 million. These upbeat results come, of course, as equity markets pushed up revenue in the fourth quarter. Another important metric here, Romaine, is monthly active users coming in at 10.9 million. CEO Vlad Tenev actually said in the release that Robinhood has brought in more funded customers and net deposits through the first half of the first quarter than it did in all of the fourth quarter. And a key point here, too, was crypto revenue coming in strong at $43 million, above the $37 million expected by analysts. Crypto trading was expected to be a standout category here with the launch of Bitcoin ETFs. And Bloomberg intelligence analysts point out that you should pay attention to that earnings call. They might talk about the impact of Fed cuts on users in the app. Over to you, Isabel.
Thanks, Alex. We have MGM Resorts. The shares are down almost 4% in after hours. It's unclear what investors are not liking here when the company reported adjusted EPS that beat estimates. So those numbers came in at $1.06, which is higher than the 68 cents estimates. EPS also came in at 92 cents. We also have net revenue. It's also higher than the forecast of $4.38 billion. This was driven in large part by the Las Vegas Strip resorts, which also netted higher than revenue forecast. And adjusted EBITDA was lower, though, at $1.19 billion versus the $1.21 billion estimates. But shares are up so far in the past 12 months by around 5%. If this continues to hold, we'll definitely see a dent there. It really remains to be seen what investors are not liking here, but we'll find out more during the earnings call. Over to you, Abby. What do you got?
Well, Isabel, take a look at the shares of Zillow. This stock has been all over the map in the after hours. At one point, down 2 to 3%. Right now, up 5%. It had been flat. They did put up a good quarter. They beat both top and bottom line estimates. They put up 20 cents versus the estimate of 13 cents in adjusted revenue or earnings, For revenue, they beat $474 million versus $451 million. And this is interesting because, of course, last quarter, that was year was one of the more difficult years over the last decade, given the fact that you had rising rates, not a lot of supply, but their presence online was key. And the bulk of their revenue, not surprisingly, $349 million of it, Romaine, did come from its core residential business. Lots of expectation that we're going to see a solid housing market this year as rates have cooled off outside of today. Let's see if that expectation continues. But there is, of course, some of the antitrust lawsuit stuff and some of the fee stuff that could weigh on shares of Zillow. But right now, not at all. Up 5% in the after hours.
All right. Our thanks there to Abigail Doolittle, Isabel Lee, and I'm going to get it right this time, Alexandra Semenova there. A nice breakdown here of some of the additional earnings that we've got. And we're going to continue on this pace here. Invitation Homes, that just crossed the wire not that long ago here. Fourth quarter revenue coming in slightly above street estimates, $624 million. Core funds from operations also coming in at about 45 cents a share. That's on the nose of what the street was looking for. The guidance going forward, funds from operations, $1.82 to $1.90. Street looking for $1.86. Pleased to say that the CEO of Invitation Homes is joining us right now for an exclusive interview. Dallas Tanner joining us here on the big program. Dallas, let's get right to it. The numbers look pretty good in the most recent quarter. I want to look at the guidance for 2024 here. Overall, looks pretty strong here. What gives you the confidence that you're going to meet those numbers?
Yeah, hi, Romaine. It's great to be with you. Ultimately, it's the fundamentals that center around housing and our customer. There's not enough supply in the U.S. today. We're tremendously underserved from a supply perspective. The customer itself continues to surprise us to the upside. Our current customer today, on a combined basis, has about $150,000 of income. They're extending their stays with us now, staying well into their fourth year. and they're continually choosing these services that we're providing. So you're picking a down payment free lifestyle, but you're getting all the bells and whistles that come with home ownership and additional services. I think people are staying longer and longer because of it.
Certainly so, and you are obviously a giant in this space in terms of single-family home rentals. But we'd be remiss in not pointing out that some of the success that this company has had, at least in recent years, has been because of it's been harder to buy a home, right? I mean, a lot of folks, they have no choice but to rent, or at least they feel like they don't have a choice. Do you worry at all that trend might actually shift, that we might actually see a more affordable home purchase marketplace?
It's really interesting. The supply still continues to be the villain, to your point. I think you're spot on with that, Romaine. What we're finding is that if you look at the U.S. homeownership rate today being in sort of the mid-60s, that's a pretty healthy number. About a third of the country continue to lease something. I think where the real challenges are, obviously there's elevated mortgage rates, and that's creating additional pressures, but there's just this tremendous lack of supply. And supply is a very local issue. We find it even in the projects that we're building with our partners. Getting through the planning and zoning process takes far longer and has much more of an economic consequence because of impact fees and things and the like. So in order to kind of free up supply and create even more choice for folks, we're going to have to see the accessibility to housing get easier. And that's going to happen at the local level. You think about the additional pressure on regional banks, and there's just a lot of the smaller operators and construction companies are building less and less of this product today than they were maybe 5 or 6 years ago.
Are you happy with your current inventory of homes in your portfolio? Are you looking to buy more?
Yeah, well, we're actually looking to build a whole heck of a lot more. Last year, we brought on about 3,000 new homes onto the platform, of which about 700 of those were newly constructed with our partners. We will look to continue to grow that year over year. Today, we have a pipeline of roughly 1,800 homes that are currently under construction that we're building, with another 1,000 plus or minus that we're really close to approving. So we will continue to lean in with our balance sheet to create a bunch of this new supply. I think what we've got to also press ourselves on is how do we continue to reevaluate what this leasing lifestyle is like? Can we add additional services and things that make this almost a no-brainer for the consumer? To where you sit there and you think about your monthly spend, you say, would I rather be spending this on a 30-year contract that's centered around a mortgage, or would I rather be down payment light and have all these additional amenities that come with it? But I think we're leaning a bit harder there.
And you already seem to have done that to a certain extent here with the new property management business, as well as a couple other things here. What was the rationale behind that?
Well, it's the power of our platform and the scale that we have. There's a lot of professional owners that have it and want exposure to single-family rental that don't have the operating capacity that Invitation Homes has. And so with the recent announcement of the 14,000 units that we brought on from one particular owner, it allows us to blend and extend our strengths as an organization. It also allows us to create efficiencies in our own business. We should be able to procure our costs at a much cheaper, run rate over time as we continue to add all these different, intelligent portfolios to our operating structure.
When we talk about the idea of building out that portfolio, whether it's what you're building yourself or partnering with to build yourself, and also some of the acquisitions that you've made in terms of other portfolios, including a couple of big splashy ones in the middle of last year, is that going to continue to be a part of your strategy?
Sure, hope so. I mean, we plan on being active. We have, the business itself generates a lot of free cash flow after paying our dividend and covering our expenses. We hope to continue to, deploy that capital intelligently. We'll continue to look at expanding our joint venture business with select partners. And we obviously want to invest as much on balance sheet as possible. So I think if and where the opportunities make sense, expect us to lean in, continue to try to stay aggressive to bring in healthy growth to the business. The wider we get, the more scale and density we get in our markets, the better services we can provide to the customer.
All right, going to have to leave it there. Dallas, great to catch up with you. Dallas Tanner, he's the CEO at Invitation Homes. Those earnings crossing the wire here, a beat on most of the key metrics. We want to turn our attention to Amazon. We're now getting confirmation that Jeff Bezos has sold roughly about $2.1 billion worth of shares. It looks to be about 12 million shares in total in a series of transactions here. Bloomberg had reported last week that Bezos had intended to sell about $2 billion worth of shares. And now we have that official filing, 2.08 billion to be precise. Shares in Amazon pretty much unchanged here in after hours trading on the back of that news. And of course, Amazon did not escape the big downdraft that we saw in the markets earlier today. In fact, all of the Magnificent Seven stocks did move lower on the day. That included a 2% drop on Amazon and 2% on Microsoft and Tesla. Though we should point out the losses that we saw in the market could have been a lot worse. At one point on the day, the S&P was down 2%, as was the NASDAQ, though they did see some big dip buying coming into the final few minutes of trading here. That will be a big setup heading into tomorrow, but we should point out yields dramatically elevated, 14 basis points higher on the 10-year yield, 17, 18 basis points higher on your 2-year yield. A big reversal of fortune now on what's going on in the yield space as swaps traders now paring back all of those bet for rate hikes that had been priced in at 5 to 6 rate cuts, for 2024. Now that's been trimmed to about 3.5. That is the setup here on the day. And when we come back, we're going to take a broader look at the market and a broader look at history, a big fat milestone for the Dow Jones Industrial Average that occurred on this day. And we're going to leave you with a question on that before we go to commercial. Of the original Dow components in 1896, can you name the companies that are still in operation today? That answer when we come back. This is The Close on Bloomberg. All right, a big sell-off in the markets today, so it's kind of fitting that we take a look back at, well, one of the biggest rallies on this day in history. Back in 1997, the Dow Jones Industrial Average reached 7,000 for the first time in its history. Now, it was more than just a nice round number. It was a major milestone in the then 6-year bull market for U.S. stocks. It took 76 years, 76 to first cross 1,000 and 15 more years to close at 2,000. But by 1995, the 1,000-point milestones really sped up to months rather than years. The Dow needed just 9 months to go from 4,000 to 5,000, 11 months to top 6,000, and just 4 to reach that 7,000 mark that occurred on this day. In fact, 8 of the 1,000-point milestones for the Dow, they were achieved in the 1990s. And that's a pace of change that still stands on its own today. Those were the halcyon days when the Dow was heavily industrial. DuPont, Goodyear, Texaco, Bethlehem Steel, Union Carbide. None of those are in the average today. In fact, the Dow originally had 12 components when it launched in 1896. And that brings us to our question of the day. How many of those still exist today as standalone companies under their original names? The answer, just one, General Electric. The other 11 original members, well, they were either taken over by competitors, broken up by regulators, or they simply closed up shop. That includes Tennessee Coal, Iron, and Railroad, which ended up in the hands of U.S. Steel. It includes United States Rubber, now owned by the French tire maker Michelin. And it includes American Cotton Oil, whose legacy can be found in the Unilever unit that now makes Skippy peanut butter. Now, GE has managed to stay in business, though it did lose its membership in the Dow back in 2018. And the Dow's influence itself has waned as well. While Dow membership still comes with bragging rights, only about $31 billion of assets managed by Wall Street are actually benchmarked to the Dow. That compares with more than 11 trillion benchmarked to the S&P 500. All right, let's pivot from, well, that to a social holiday that generates roughly $26 billion worth of energy from the lovers out there. I'm talking about Valentine's Day, guys and girls. While some couples may opt to shower each other in gifts and material items, some couples and singles actually prefer to dine out at their favorite restaurants for just a nice meal. Debbie Su joining us right now. She's the CEO over at OpenTable, which of course tracks a lot of these dining trends. And one of the more interesting trends, Debbie, that I saw when it comes to Valentine's Day, that a lot of the folks dining out aren't doing it sort of one-on-one, if you will, sort of a couple out there just staring each other in the eye. It's singles and groups of people. Is that right?
That is right. And thanks for having me back, Romaine. I'm patting myself on the back because I guessed GE in your last prompt. But you are right. Valentine's Day is not just about partners anymore. We're seeing people going out and celebrating by themselves with large groups of friends. For example, today, I didn't know if you know this, is Galentine's Day. and we're seeing dining activity up 8% year over year, and that's driven by parties of 4 or more. So it's really become a holiday, a dining holiday, not just for couples, but for friends, for families, for loved ones.
I've heard of Galentine's Day, and I just learned about Palentine's Day as well, which I don't know if that's today or when it is, but it seems to be a trend where a lot of folks are maybe trying to, I guess, reclaim Valentine's Day from just the lovers out there.
That's exactly right. And, the other trend that we're seeing this Valentine's Day, and we saw it last year as well, it's actually Valentine's week, because dining activity is not just happening on the 14th. It's actually happening all week. Like today is an up day in dining, and we're continuing to see dining activity pick up for the rest of the week after Wednesday. So
is it good enough for me, I'm asking for a friend, to just take someone out to dinner, or do I still have to get them, flowers, chocolates, and all the other stuff?
I think it's a good reservation at a restaurant is hard to secure. So I feel like if you've made that reservation, you're already ahead of the game. We saw last year, actually, that procrastinators are big players in this market. Mm-hmm. Last year, 30% of diners booked the day before Valentine's Day. 18% booked the day of Valentine's Day. So Romain, if you have, for your friend, if your friend has a reservation, I feel like that's going to get it done.
Oh, okay, well, talk to the procrastinators out there. Not me, but I have some friends who wait to the last minute for everything here. So if they want to go to a nice restaurant, and given that we're less than 24 hours away from Valentine's Day, are they going to have any chance of getting a reservation on an open table for anything?
Yes, they definitely have a chance still. So for procrastinators out there, go on to OpenTable. We have a feature called Notify Me. So if your favorite restaurant is booked up, you can set an alert. And if something opens up at that restaurant, they will reach out. We still have a myriad of experiences, special experiences, of romantic lobster dinner, for example, at Colomon in New York, that are available. And be flexible with your timing. You don't have to eat on the 14th. As I said before, the dining activity is happening all week long, especially in cities we're seeing like New York, San Francisco, LA, where the day of Valentine's Day is looking pretty steady, but you're seeing it, the Thursday, the Friday, the Saturday after, where it's really picking up.
I am curious, once we get past Valentine's Day here, Debbie, just about the general health right now of all of us dining out. We know that there was that big boon when the kind of the pandemic cloud started to clear, and we all were just really itching to get out there and socialize. Is that still holding up, or are we starting to see that moderate?
We're seeing dining demand hold pretty steady. January is typically a slower month. It's, you're recovering after the holidays in December. Lots of people are practicing dry January. We're hopeful that this February and this Valentine's Day is going to be a great period of time. But I think that from our data, and we have a lot of it, every second, 6 tables are booked on OpenTable. So what our data tells us is that even during times of macroeconomic uncertainty, people continue to prioritize dining out. They're continuing to prioritize the experiential, and we hope that holds for this year.
Is the sort of, I guess, the economics of it all, is that favorable to restaurants right now?
It's a rough climate for restaurants right now. They are facing rising labor costs. They're facing rising food costs. They're facing labor shortages. And, it's a tough time in general, even during normal conditions. Restaurants operate with a 2 to 3% profit margin. And so when they have other factors like this come in, it can be really devastating.
All right. Well, hopefully everyone gets out, or if not tomorrow, maybe Thursday, and maybe the days after that, take out your significant other. And if you don't have one, just, find a friend and enjoy yourself. Yes. All right, Debbie, always love fun.
That's exactly right.
Always fun talking to you, and you guys always have some great data, some great trends here going on in the restaurant space. Debbie Su, CEO of OpenTable. All right, show's not over yet. We're going to set you up for some of the big market-moving events coming up over the next 24 hours. Stick with us. This is Bloomberg. We told you there were going to be a lot of market-moving catalysts this week, and tomorrow is not going to be any different. The SEC will receive a lot of mail tomorrow, but it won't be Valentine's Day love notes. We're talking about, well, those 13 Fs. Hedge funds must submit their quarterly 13F forms by February 14th. Joining us right now as to, well, what to keep an eye on is Hema Palmer, our Bloomberg hedge fund reporter. And Hema, what are going to be the big themes that we're going to keep an eye on tomorrow?
Yes, so we are looking at a number of different things. Tech stocks tends to be one that we see a lot of rotation amongst these managers. I'm curious about AI sentiment. A lot of these guys were bullish on AI. I'm curious if that's changed in the past quarter or so. We're going to be looking at general market exposure. Some of these hedge funds brought down their exposure earlier in the year. And so we're curious if in the last quarter of last year we saw a push back into the market or a receding from it.
What type of names do you pay attention to most? I mean, I feel like we always want to know what Warren Buffett did. We want to know what, the Tiger Cubs did. Is that still going to be the ones that we pay most attention to?
Yes. So with these filings, we care about the stock pickers. So think the Tiger Cubs, think Greenlight, Third Point. A lot of these funds are focused on stock picking because we can see if they have a directional view or a bet against or on some of these stocks, and it's helpful for us to compare it to previous years.
And when we talk about their performance and we talk about, I guess, whether we can extrapolate anything from it, I mean, everyone kind of poo-poos these because they say, well, okay, look, this was basically 3 months ago, or I guess the end of December or whatever. So you're getting something that's very backward looking. It's hard to know whether they still hold those positions, but there's still value in these reports.
There's still value. Hedge funds are notoriously secretive. So this gives us some glimpse into how they traded in the past quarter. It's not how they're positioned now per se, so it is a bit dated. The other thing to keep in mind is when we're looking at some of these funds, we don't multi-strat funds or these quant funds, they trade in and out of stocks so quickly that a snapshot of them at the end of December may not tell us that much, especially because they have a lot of hedges and we don't have full clarity. So that's why we look at the stock pickers a lot.
All right, our hedge fund reporter, Hema Palmer here. We're going to catch up with her tomorrow as those 13F filings are scheduled to drop. Of course, we'll have full coverage on Bloomberg throughout the day as they come down. Some other catalysts to keep an eye on over the next 24 hours, including overseas. We get a big election coming out of Indonesia that could have big ramifications for emerging markets. And then, well, we want to go back over, and you see some of the candidates there, and then we want to go over to the UK, where we are expected to get the inflation report out of there. Remember, the inflation situation over there much different than what we have here in the U.S. And then we do come back here into the U.S., because remember, that big CPI report that we got this morning, the real key that we want to look for is PCE data. And what feeds into that is PPI, producer price indexes. We get that PPI report on Friday, but tomorrow we're going to get the revisions from the prior year. So it'll be interesting to see whether that's materially different than what we saw in those CPI revisions that, well, was a little bit of a dud. As we were just talking about, we're also going to get those 13F filings where we learn what hedge funds actually bought and sold in the last quarter of last year. A bit backward looking, but something to always keep an eye on, including that man there. And quite a few earnings also scheduled to cross the wire tomorrow, including Barrick Gold, Kraft Heinz, CME Group, TripAdvisor, Cisco, Twilio, and Occidental Petroleum. We'll have full coverage right here on Bloomberg as we do every day. I'll be back tomorrow. Balance of Power is up next. This is Bloomberg.